Hello and welcome to Fixed Income Markets, our periodic appointment with the fixed income specialist Francesco Castelli from Banor Capital in London and in Italy. Francesco, welcome again.
Hello, Marcello. Thank you for having me.
Sure. It's been clearly a strange and difficult year in the fixed income space. Why don't you take us through the key events that has shaped the markets in its various components so far?
Yeah, fixed income market with two different sides. There's a side driven by duration, interest rates, and expectation for monetary policy. This has been the difficult side. As you can see, rates have moved higher for the year unexpectedly. But on the other side, growth, especially in the US, has been much stronger than expected. And so this has delayed the expectation for monetary policy easing. And these, of course, all duration-driven activities have been under pressure, so prices moving down. On the other side, credit has been a positive development. And as you can see, spreads have tightened markedly, especially in the high yield component, so especially in the component driven by lower rated issuers. These two sides, interest rates up, spreads down, have produced a seemingly strange rotation for the beginning of the year. On one side, government bonds have moved down in price, so they're posting a negative return year to date. The credit component driven by high bonds or subordinated financials has done really, really well. In this component, the spread compression have more than offset the increasing rates. And so we have positive returns, very good returns in some cases. The corporate bond component is in between because on one side, corporate bonds suffer from higher yields, of course, like government bonds. On the other side, they enjoy some spread compression, but being highly rated corporates, the spread compression in this case is more limited. And so that's why year to date, they are posting slightly positive returns. This can be seemingly strange, but as you can see, it's kind of normal. The medium-term correlation metrics shows that high yield in general, they have zero correlation with government bonds. High yield on the other side tend to be much more correlated with equities. So that's why we consider them a risky asset class, and maybe why we are also more prudent on this asset class after the very strong return of the beginning of the year. Where we are left now? Well, in terms of monetary policy expectations, the bar is not very high. The beginning of the year, we were expecting 6, maybe 7 cuts from the Federal Reserve and the ECB. Now we're left just with 2, 3 cuts. We were expecting central banks to start in March, while they probably will start in June for the ECB and in September for the Federal Reserve. So plenty of time. That's why we are after the difficult start for government bonds. We think now there's maybe some additional indication that duration is no longer a risk, maybe it's an opportunity from an investment point of view. It's also interesting because duration exposure is generally driven by economic conditions. This is a surprise index that interestingly, this surprise index tells you how economic data are, the index tells you if economic data are beating or underperforming economic expectations. This is an index that has been developed for bond trading specifically, so it's particularly important for professional like us. And as you can see at the beginning of the year, this index continued to show positive performance. So on average, economic data were stronger than expectations. And of course, government bonds have underperformed. Now the index is moving in negative territory, and in the last month has done really a movement down remarkable. And that's why we believe that duration and government bonds may now be more of an opportunity than the problem that they were in the first part of the year. Credit-wise, as I was mentioning before, we are starting to turn more conservative. There will be some economic slowdown, and so this is going to have probably an impact, especially on lower rated issuers. We tend to focus more on relative value opportunities, and it's interesting to note that, for instance, areas of the credit market like bank-issued bonds have lagged a bit behind, so they look very, very cheap. So yes, an environment where, as an investor, you have to be more prudent, but an environment where you can still find some opportunities for investments.
Perfect. Thank you really very much for this overview, which I try to summarize, simplifying it, of course, to the benefit of our students. So first of all, as a disclaimer, we are not giving any investment recommendation. That's not the purpose. We cannot do it. We don't want to do it, but it's educational. So where we are is, we were discounted at the beginning of the year, 6, 7 rate cuts. Now we are in the field of 2, 3, and some people are actually even saying maybe not even 1 because inflation will persist. But let's say consensus is 2 to 3. We had a much better macro up until recent, at least, and Europe, correct me if I'm wrong, seems to be finally catching up after a few quarters of disappointing data. And
Yeah.
what you're saying is that if the consensus is right, maybe after a difficult year on the government bond side, duration, a longer duration, some clients will start to implement a longer duration trade from this point of view. Yeah?
Yeah, that's correct. Of course, if you're not a trader, probably you shouldn't be playing with duration at all. What we tend to believe is that for the average investor, there are periods in which you have to be careful about duration and periods where you have to be relaxed. Taking a bit of duration today means that you can lock in interesting rates, corporate bonds, government bonds, so highly rated issuers now in Europe offer yields that are in excess of inflation, so you can protect your capital from inflation without taking huge risks. And this is the reason why we say don't worry too much about duration today. It's going to be an opportunity, not a risk.
Perfect. Again, I'm stating the obvious, but I want to make sure we're not giving investment advice, but just an educational overview. Thank you very much again. I'm very pleased to have Banor Capital and Francesco Castelli as a regular guest on our fixed income markets bi-weekly appointments. Thank you, Francesco, and see you soon. And for people wanting to find out more about the Academy, Mercury Partners Academy, just visit mercurypartners.net, and you can see a lot of information, a lot of videos with esteemed guests like Francesco. Thank you. Bye.
Thank you very much.